Hello traders, this is not a trading video, this is an informational video, but it's only for a specific group of individuals, accredited investors. What that simply means is that you have over $1 million net value, not including your residence, and/or you're making $200,000 a year, and you have done so the last 2 years, and you have a high expectation to do it into the future, or as a couple, you guys are making $300,000 per year, and/or you can just put $500,000 into an investment at your will. So, with that said, that's what's called an accredited investor by the SEC. And that's who I'm talking to on this video. If you're not that individual, feel free to stay if you'd like, or just go look at the trading videos that we post. Now, my name's D7. It's AKA D7. I'm Des. I own Grok Trade, and I am getting my license to be an investment advisor for this one purpose, and that is to manage retirement accounts or cash accounts for individuals, high net worth individuals. I'm in that process because I have an algorithm. The algorithm I have built is highly profitable. Now, why I'm showing you this is because I'm putting together a small list of accredited investors that I'm keeping updated to the algorithm and what we're doing and where we're at on the algorithm. If you want to be kept up to date on this algorithm and you are an accredited investor, send me an email at des, at groktrade.com. Delta Echo Sierra at groktrade.com. That's me. We'll have a small chat through email, and I'm happy if you're a credentialed accredited investor. I'll be happy to add you to my short list. So I'm a short list. There's 12 accredited investors who are on this list right now. It is growing. All right, let's get to this. The reason I'm doing this is because my algorithm, I'm trading with my own money right now. And the last I looked on Friday, I am up right around 20% in 1 month on my account. And it happens to be a retirement account. I could not be happier. All right, so let's get into it. What I'm showing you here is the Dow Jones. This goes back 105 years, okay? 105 years, I did the average. And I had this average wrong because I did this by hand, and now I let a computer do it. The average is not 12.6, which I told everybody on the accredited investors on my last video. It's a private group of you. It's not 12.6, it's 8.6. So it's 8.06. We'll just say 8% for the last 105 years. So remember that. That's all I want you to do is remember 8%. So if you're in the markets, if you're not making at least 8%, it's whatever you're in is trash. But what is more important to me is the 45-year. 45-year is when most of us have been investing in, okay? So these numbers are more relevant to us. So I took the Dow Jones, the S&P 500, and the NASDAQ. The only reason I didn't go back 50 years or 60 years because they weren't around then. So 45 years gives us some good detail on the NASDAQ and S&P 500. Anyway, let's scroll down here to the bottom. I averaged out these guys in going back the 45 years. You can see 45 in the yellow. Averaged them out. I averaged all three of these guys out, 11.26. So we went from 8% to just over 11%, okay? So if we move over here, this is the 10-year, and this is the 8-year. So I went back 10 years here, 1 decade. I went back 8 years. That gave me better results. Anyway, the highest percentage we have is about 14%, just over. So in other words, I think we should at least be making 8%, okay? We should at least be making 8%, but don't expect to make any more than 14%, okay? I think that's a good, fair look at it. And I think a good, fair average is 11%. So I'm in your own retirement accounts. You need to be thinking, if I'm not making at least 11% per year, I'm lagging. And in the hot bull market run, you should be at least making 14%. Not at least, on average, that's what where you should be. Okay. So just be thinking 8 to 14, but they'll keep it simple for you, at least 11%. All right, at least 11%. Now, I wanted to know how the hedge funds were doing. I was able to get information from Interactive Brokers because you're a hedge fund, you're registered with the SEC, and you have to disclose your performances legally. And assets under management, it shows us all this. I'm not going to pay attention to 2020 because we're in the middle of 2020 right now. All I really care about is what we did last year and the last 3 years from there. So I'm looking at these 4 years. So let's go down and look at what the hedge funds have done. The average hedge fund did these percentages right there. You'll notice there's a negative here. That negative is 2018. 2018, they lagged the markets. Well, because the S&P lagged the markets by 4%, 4.5%. So this line shows you the S&P performance. This shows you what the hedge fund did. Okay? All that really matters is the net between the two. In 2018, or 2019 rather, the S&P outperformed the hedge funds by 8%. 8%. Hedge funds lagged the broad markets by 8%. 2018 beat it by almost 3, break even in 2017, and then beat it here 2016. If you just do a quick average, minus 8, add these guys, it's almost a break even. The last 4 years of data that I could get on hedge funds is a wash. Most of the time it beats it, but not by a lot. But when it misses it by a lot. Okay, that's our experience the last 4 years. In other words, if you were to put your money with a hedge fund, don't assume you're going to be beating the broad markets. I have hard data here to show this. Okay, now, all I want you to know now is simply this. The Dow, last 105 years, 8%. Last 45 years, just assume a good average number is 11%, as high as 14. Okay, that's what you can expect per year, buying and holding in the marketplace. That's what you can do. Hedge funds, you're going to be breaking even at best. I have hard number on 44 different hedge funds. And these are the largest hedge funds with Interactive Brokers, which is one of the largest brokers internationally. This is where all hedge funds, institutions, we all love Interactive Brokers. That's where we go. That's our broker of choice. All right, moving on. A reward to risk ratio. Now, this is important that you understand. I am looking at when we teach, we'll make it 1,000. When we teach, we're teaching this. We want a reward to risk ratio of 2 to 1, meaning for every dollar you're risking, you're getting 2 back. For every dollar that you're putting at risk, you're winning 2, okay? A 2 to 1 reward risk ratio. That's what that number represents right here. But we also need to be winning more than we're losing. We want to be at 60% plus, at least 60%. If you hit those two metrics right there, your risk per expense trade, meaning that when you lose on a trade, you're losing $1,000. But that means when you win on a trade, your averaging win is $2,000. If that's the case, meaning that you are getting a 2 to 1 reward risk ratio after, let's say, 25 trades, you will make a net $20,000. So in other words, if you are risking $1,000 and you lose on a trade, you lose $1,000. You trade 25 times in 1 month on average, and you got a 2 to 1 reward risk ratio, and you're winning only on 6 out of 10 trades. You will make $20,000 per month. That's if you're doing 25 trades per month, hitting those ratios, okay? That's what this is showing you. per month. If you do 25 trades per week, you will be making $20,000 per week. Now, we also teach that if you do at least 1.6 and you're at 40%, meaning that you lose 60% of the time. So out of 10 trades, you're only winning on 4. You're not even doing a 50-50. If that's the case, you will net $1,000 in that month if you do 25 trades in that month. Every 25 trades, you'll make $1,000. That's only trading 40%, not even 50-50. A monkey throwing darts can do 50-50. But the reward to risk ratio is 1.6. If that's the case, you will squeak out some money. Now, what we're looking to do is something far greater. And this is where I want to go over and show you what our algorithm is doing. Most of the time, big hedge funds, big institutions, banks, insurance companies, they are the ones that have the buying power to create and to have algorithms for them to maximize profitability in the marketplace. I have been working on this for many months, my 22 years trading experience on an algorithm. Finally, we small people have access to an algorithm that is highly profitable. And I'm going to show this to you. It's for long-term trades. We only trade long, meaning that it's designed for retirement accounts, okay? It's designed for longer-term cash accounts. We're not trading in and out a lot. So to put this in perspective, our algorithm has been back-tested 7.5 years because we're using a leveraged ETF, and that leveraged ETF started in 2010, but my algorithm needed 3 years worth of data to have enough data to start calculating trades. All right. What you're seeing is the inverse ETF, not an inverse, it's a leveraged ETF, and you're seeing buy and sells. This is on a weekly chart. Because it's on a weekly chart, you'll go many, many weeks without having a trade. So it's more of a buy and hold, but a highly managed buy and hold strategy, highly optimized and highly managed. In this example, we had 61 trades, and that means trades in and out. 61 trades in 7.5 years. I'll do the math for you. Basically, that means each quarter, every 3 months, there is one trade that takes place. So to put it in perspective, each year we're going to trade the account 4 times. Only 4 trades will take place on average in that account per year, but they are highly pinpointed times when we need to sell and when we need to get back in to maximize profitability. All right, that gives you a little, you've already been looking at the numbers here. Let me explain the numbers to you. In this scenario, we put $100,000 into the backtesting scenario. $100,000 where we started. 7.5 years later, we are up right now $2.9 million. $2.9 million with a first initial investment of $100,000 and no additional monies put in. That's this scenario. That's why you're seeing the 2.9 right there. So this is with compounding and everything. 61 trades. Our win ratio is almost 84%. It's 83.6%. In other words, when we're teaching our students, we're teaching them to hit a win ratio of 60%. We want them making 60% or higher. We're already doing 84%. That is an unbelievable number. That number is incredible. In other words, the likelihood of having 2 losing trades in a row, consecutive losing trades, is highly unlikely with that percentage. With that percentage, what's highly likely is having multiple strings of winning trades in a row. The profit factor is a name that also means reward to risk. Okay, it's a reward to risk ratio. For every $1 that I'm losing on a losing trade, I'm making $4.76. So almost $5. I lose I lose a buck. When I win, I'm making $5. That is incredibly strong. Our max drawdown on average is only 19%. So if you can stomach a 19% drawdown, which everyone can, your drawdowns are much more than that in coronavirus drops and in the drops that we get in financial crashes or technology crashes that we've experienced in the last 20 years. Those crashes are significant. We have a pull down of 18.96%. Max. I want you to remember this 84 win ratio and the 4.7. Watch this. If I go back to this and I put in the a 4.7 right there, and the win ratio of 83.6, because this changes day to day because this is real time what you're looking at right here. So 0.6, and we're not going to do 1,000. We're going to at least, we'll say 10,000. So if you lose, you're going to lose 10,000. Okay, each one you lose, you'll give back 10,000. After 25 trades, you're almost at $1 million. This puts it in perspective for you. This is a very, very real scenario. Very real scenario. So those are the numbers that we are hitting. Virtually what we're looking at on $100,000, you make this 13,000. Hold on. What was that number? 4.7, 84. Oh, yes. And then we go to 61 trades. Remember, we had 61 trades. There it is. In 61 trades, we're doing 84%. We're at 4.7 reward to risk ratio. Our losing trade on average with our 100,000 initial put in, on a losing trade we would lose 13,000. That puts us right at that 3 million to 3.9. So now let me show you something insanely. This is the compounding part. Okay. If you look at this percentage, the 28.91 right there, and divide that by 7.5, that will give you a compounded average of in the 300s somewhere. That is incorrect. We got to back out compounding completely and say, what is the true average year over year? That true average year over year is 57.33%. So in other words, our algorithm has produced the last 7.5 years a net profit gain of 57.33% per year. That, if you were to have an initial investment of only 100,000 in your first 3 years, you're going to have, at hitting those numbers, $389,000. In 5 years, almost $1 million. 10 years, over $9 million. So what I'm looking for are individuals who are going to stay with me for 5 to 10 years with the assumption we are smashing the 11%. Remember, we're looking for something better than 11%. We're doing 5 times that with our algorithm. 11% is what the masses are doing. This is an algorithm that's not for the masses. Legally, I can, as a registered investment advisor, which I am not at this moment. I'm getting my training and I'm going through the test and I'm going through all the hoops to be registered with the SEC. When that happens, I will be a registered, nationally registered investment advisor. At that point, I can partner with individuals. I can take on clients, accredited investors, and I can be part of the performance that comes through. So when the performance comes in, I get to play too. I get a part of that. That's what I'm looking for. That's what I'm looking for. I'm looking for accredited investors to come in. Now, I think a good average starting investment, 500,000, put 500,000 in, and then put in more as you see performance. Several of the accredited investors are starting with multi-millions coming in, but I think start with 500,000. If we hit the 57, that's what you're looking at in 3 years. But I'm looking for people that will stay 10 years. It's because this is a retirement thing. Stay with us, stay 10 years. We want that $500,000 to become 46 million. The algorithm hitting that. But what I did was I said, let's cut that in half. Let's say we do not keep up with the 57.33. Now, mind you, I'm trading this live in my own account. I'm up right around 20%. I got to look at that. I should have actually looked at that before I did this video. Maybe just under 20%, at least 17%, and no more than 21%. So that's where I'm at right now in my first month trading with the algorithm. So the algorithm is already outpacing its average right now. Loving it, loving it, loving it, loving it. Now, if we only do half, so let's put the 500,000 in. If we do half, we only do 28%. Okay. Again, I'm doing no less than 17% my first month number 1. So this is I think fair. Let's cut our 7.5-year average in half, right there. In 10 years, your $500,000. If you buy and hold, don't take anything out. But we will take it out because I'm going to have a performance fee on this. So, but this will be the gross. You will have a gross of $6.2 million with that. Let's say we only do 20%. We do 20%. 5 years, you're at 1.2 million. At 20%. At 20%. So there you're doubling it. You're 101% at that point. So, I mean, we could look at these numbers, but those aren't important to me. I really think that I would be really surprised if the algorithm were to perform at 20% on the year. I can't pragmatically see that as possible, but anything can happen in the markets, of course. The markets are risk. This is not financial advice at all. This is looking at data numbers off of an algorithm that I have going on. But let's say I think what would be fair is 28.67. It's half of what we're doing. If you're going to start off with, say, $1 million, start off with $1 million, we do half. In 3 years, doubled. 5 years, you'll be 3.5 million. But that 10-year mark, you're at 12 million. Now we're talking about money, right? The 12 million mark, that's money. That's doing really exceptionally well. And it gets stupid crazy after 15 years. You can see this, and you can see 20 years. It's really impressive numbers. But let's say we're only doing 20%. We're almost doubling at 20. We're doing what Warren Buffett does. Okay, we're doubling what the markets are doing. We only do 20%. You put the 10 million in, or 1 million. Sorry, 1 million. You start off with $1 million, you can add to it. Back up the truck after 6 months if you like what you're seeing. But you do that, 20%, you can see the numbers right here. In 10 years, that 1 mil is over 6. It's over 6. 5 years, more than doubling. It takes a little longer to double your money, but 5 years doubling your money, not bad, not bad, but 20%. So the number that I'm kind of focused on is this up here. That's what I'm looking at. That's what I'm looking at. That's compounding. Yeah. So that's so for example, let me see here. If I go back to this, if you do $1 million, we do hit our average. Okay, we do hit that. Those are your numbers. This gives you the 7.5 year. If you just held it 7.5, that's what you would be right there. 29 mil, which is really, that's a wow factor. That's a wow factor. So what you're seeing at this moment, having this video, and just so you guys know, I will be able to help for those who are retail investors. That is those who are not accredited investors. I will still be able to help you. Okay, you're not going to be left out. I just won't be able to help you as aggressively as I can the accredited investors legally. Okay, accredited investors, the government deems more sophisticated, and they allow them to do more things with their capital than retail investors. That's just how it works here in the United States. So just a little backstory. I wanted a trading algorithm. I've been wanting one for a long time, and I have had teams of people working on this, many developers all over the world. I have sunk a lot of money into this. Darn near gave it up. I couldn't believe how difficult this was. Finally, in the 11th hour, hit on a winning system. And this system is fantastic. So I believe it's just a matter of time before institutions will be reaching out to me. I will license the algorithm to bigger hedge funds, bigger institutions who need one. I'll be happy to do that. I love that we now have access to it. We don't have to go to a large hedge fund to get access. We don't have to be part of an institution. We have it now. So my developers went smaller. The closer we got to a winning system, my developers got really small. Now there's only one person in the world that knows the algorithm. It's the black box. It's a black box. We're not letting anybody know about the code. And that person is locked down with a non-disclosure agreement, an NDA. And this algorithm works on multiple stocks. And let me show this to you. I have to go over. Let me go to a list of, you don't see what I'm doing. I'm on another screen here. I'm going to go to, let's go to my tech stocks. And then what I'm going to do is scroll this over so you can see them. This is my tech stocks. Anything you see a blue or a green flag on, my algorithm works on. The greens work on my algorithm the best. So that's just on my tech stocks, okay? Just on my tech stocks. But the ETFs that I'm looking at are, and I especially like the leverage ETFs. And because you're an accredited investor, I can do leverage ETFs. But anyway, with you guys, more so than I can retail investors. So I showed you these. Let me show you something else, performance. So if I go here, you will see, oh boy, let me scroll up. Oops, scroll up just a little bit. Scroll down a little bit. Okay, now you can see it. This shows you, and I'll show you all the data. So you can see all the data here. This is just mumbo jumbo stuff. But what really matters to me, what really matters to me is this. Not only are we making 57.33% per year on average, back tested. Not only do we have that, but we also have this. We also have a buy and hold return was 2,200. We're at 2,900. We are beating buy and hold. That's important. Can you not only make money, but can you beat the buy and hold? And that's hard to do when something is running straight up. If the stock is running straight up, it is hard to beat. This is beating it. We beat buy and hold by a lot. By a lot. And the other benefit that we have here is we don't hold through large drawdowns. When the market crashes, the algorithm gets us out of the way. So the benefit that we have here, and the reason is the algorithm is more than that. It's a 1-2 punch. The algorithm is producing fantastic results. The time that we're selling and out, we're not just waiting. We will be engaging in other trades to be making money at all times. If the market crashes, the system is set up and it watches it every minute of the active day. And if we get a crash, just like the coronavirus, overnight, man, we had a big drop. I'm going to liquidate all of us and sit back, and we're going to watch to see what happens. Okay, I'm going to manually override the algorithm. Now, the algorithm doesn't automatically trade. I oversee the trades on buy and sells. I make the ultimate decision. I do the point and click and say we are in, we are out. The algorithm does the heavy lifting. It gives me all the times I should get in and out of these trades. But I make the final decision on if we are, in fact, getting in or if we are getting out. That's my 22 years experience that I will be overseeing the algorithm. So that's where we're at. Ultimately, if you're an accredited investor right now, retail investors, I will keep you updated as time comes when I'm ready for you. I'm not ready for you guys. But I am ready to keep accredited investors updated to what it is we are doing. We're at 12 accredited investors. We have a lot of money that will be coming into this. But what I'm doing up until January 1st is when I think that I'll have a company and I think I will be ready with a firm and be ready to open for business. So be thinking January 2021 will be go time. If you want me to stay in touch with you through emails from this point to that time, Des at groktrade.com. Be happy to chat with you. So I hope this was informational. So take care. We'll see you guys later. Bye.